In this video, we're just going to go through a deferrals example for reversing entries. And again, like I kind of said here, this could be like a maybe do on your own kind of a problem. One of the reasons I put it in a separate video. So again, we're doing a very similar format to the accruals example that is in the other video on reversing entries. So first, we're going to be doing it using reversing entries, okay? So let's say we have this company and they purchase supplies of $5,000 in July 1 of 2017. ABC company has a policy of immediately expensing all supplies it purchases because it uses so many supplies that it assumes that it will use them by year end anyway, right? So ABC is this company and they're a big company and they use a lot of supplies. And so just for administrative ease to simplify their accounting process, okay, they say, well, we're gonna use these supplies by year end anyways. Let's just expense them now so we don't have to worry about it at year end. That's basically the point, right? Because if we use all these supplies at year end, then our books are going to be properly stated. We're not going to need to record an adjusting entry, okay? So for using reversing entries, the journal entry for this transaction, for the very first transaction of purchasing the supplies, would be debit supplies expense for the full $5,000, credit cash for $5,000, okay? That's the first journal entry, right? We're expensing all of it up front because we think we're going to use these supplies. It's a reasonable assumption. We've done this in the past, okay? Now, on December 31 of 2018, ABC actually finds out, oh, they have $500 on hand of supplies, okay? 500 supplies on hand. Well, we actually have to record adjusting entry in this case, which means that the adjusting entry is to debit supplies for 500 because that's how many we have on hand, and then credit supplies expense for 500 because we recorded too much expense, right? We can't record 5,000 of expense if we actually only use up 4,500 supplies. Where's the 4,500? Well, we buy 5,000 and then we have 500 on hand. Well, that means we would end up with $4,500 of expenses used, right? Or sorry, of supplies expense, right? That's how much supplies that we actually used, right? So we can't record 5,000 of expense. We can only record 4,500, right? So we could see in the supplies expense T account, okay, we have 5,000, but we can only record 4,500. So we actually have to credit credit supplies expense for $500, right? So we end up at $4,500, which is the amount that we actually use, okay? Then the next part is on January 1st, the reversing entry for ABC would be the following, okay? And again, it's literally the same numbers, 500, with supplies expense flipped to a debit because it was a credit, and supplies is credited because it was debited before. It's just the exact reverse of what we did in the adjusting entry, okay? So now we can see that if we just look at the journal entries, the T accounts, we can see what's going on. So on the supply side, okay, we start out with 0 because when we first make the journal entry, we don't actually do anything, right, with the supplies account. It's not actually debited or credited or anything. Then we actually debit it for 500 at year end, okay? And supplies is a balance sheet account. It's not going to be closed out, right? So that means that it will just have an ending balance of 500, okay? Then when we actually make the reversing entry, we literally just zero out the account, right? We have 500. We assume in 2018, we use a lot of supplies. We're going to use up these supplies in 2018. So let's just go ahead and take off these supplies and we'll just expense the supplies, okay? So that's basically the supplies T account. Okay, so we end with 500 in the 1 year, and then the next year we have 0. Supplies expense, on the other hand, like we said before, we end up with 4,500, but we actually have to close that out. There should be a 4,500 here. So that would mean that when we close out this account, we end up with 0 balance because it's a revenue or an expense account. It's an income statement account. Okay, and then finally what happens is we start off with 0 in 2017. And then we debit for 500, the supplies expense on January 1 of 2018. We're just reversing it out what we did the day before. So we're assuming we're going to use all these supplies. So we end up with $500 of supplies expense as of 2018, okay, for 2018, assuming there's nothing else going on, okay? Now, we flip over to the without reversing entries, and we're going to go through this, and then we're going to compare them, and we're going to kind of see that it works out in a very similar way that if we've seen the accruals video that it works out in a very similar way, okay? Now we kind of have these same facts as above, except now ABC does not expense its supplies immediately upon purchase. So again, this company purchases $5,000 supplies on July 1st. But now they're not using reversing entries. They don't think that they're going to use all these supplies, so they don't expense them all. Okay. So now July 1, we have a journal entry of debiting the actual supplies asset and then crediting cash, okay, to pay for these supplies. Then on December 31, again, they have $500 of supplies on hand. The adjusting entry for this is to actually record the expense, right? This is what we're used to seeing in 2021. So we say debit supplies expense, credit supplies for $4,500 for the amount that we actually used, right? We used $4,500. We want to go ahead and record $4,500 of expense. All right. Now on January 1st of 2018, the entry is no entry, right? Because there is no reversing entries in this example. All right. And then finally, we have one additional entry for the without reversing entries example. Okay. So now the thing is that in 2018, we actually use up all these supplies, right? That's what we assumed in another example, and that's actually what happened. Okay. So now the adjusting entry on December 31 of 2018 has to be debit supplies expense for 500, credit supplies for 500, because this $500 balance would still be in supplies, right? Because we started with 5, we took 5,000, we took away 4,500, we would still have $500, and we would need to expense those. Okay. Now we can look at the T accounts, and then we'll go ahead and compare. So for supplies, again, we debit it for 5,000 at the beginning, and then we end up crediting off 4,500 as our adjusting entry. We don't have to close out the supplies account, so that means we end up with $500 of supplies on hand at the end of the year. It's a balance sheet account, it's an asset account, we don't close it. Then on December 31, we record this entry to actually zero out the supplies T account because there's nothing left. Okay, we used up all the supplies in 2018. Supplies expense side, okay, we don't record anything initially because we don't actually expense anything on July 1st of 2017. Then the 4,500, okay, that's for this December 31 adjusting entry, we record 4,500 of expense. This right here will be the closing entry to actually close out the expense account, zero ending balance, okay, which means a beginning zero balance for 2018, zero ending balance for 2017, beginning zero balance for 2018. Then we record 500 of expense in our adjusting entry, and then we have 500 of expense total for 2018. We would need to close 2018, but we're not as concerned about that in this problem because we just want to show that over the two different scenarios, with and without reversing entries, that we have the same amounts recorded. Okay, so we would need to close this, but we don't need to worry about that in this example. Okay, so we'll look at this. Okay, so in 2017, we end with $500 in our supplies T account, and we end up with zero in our supplies expense, but we were actually record 4,500. Okay, so that's kind of the key. We recorded 4,500, we end up with 500 on the supplies. Well, we see the same thing. We record 4,500 here, and then we have $500 left in our supplies T account. Then under the with reversing entries, again, we have zero in our supplies T account, and we record 500 of supplies expense during 2018. And then without reversing entries, again, zero in the supplies T account at the end of the year, and then we record 500 of supplies expense. So the thing is that you can kind of compare these and you can see, okay, there's just less to worry about with the reversing entries because you just sort of expense it up front. And then if there's nothing left over at year end, you don't have to do anything, right? So if at December 31 of 2017, right, if ABC actually had zero on hand, then there's no adjusting entry to make and there's nothing to do, right? Literally, ABC would be fine just making this first entry. Whereas without reversing entries, okay, if you do this first, if you have zero on hand here, you actually still have to make this adjusting entry for $5,000 with the same debit and the same credit. And so it would be less journal entries and less hassle under the reversing entries way, as long as you're just using up a lot of supplies or whatever you're buying that is an expense. Okay, so that's the end of this topic.